Imagine you want to invest in the Indian stock market, but you're not based in India. You'd have to go through a lot of paperwork and regulations, which can be a hassle. This is where participatory notes, or P notes, come in. P notes are like financial instruments issued by registered foreign institutional investors, or FIIs, to overseas investors. These investors want to be a part of the Indian market without going through the usual drill of registering themselves. Think of it like buying a slice of pizza from a friend who bought the whole pie. You get to enjoy the pizza without the hassle of ordering and waiting. P notes allow foreign investors to participate in the Indian market without directly registering with SEBI, the market regulator. They are a derivative instrument, meaning their value is derived from the underlying Indian securities they represent. In essence, P notes are a way for foreign investors to get a taste of the Indian market without diving into the deep end of regulations. How do P notes actually work? Let's say you're an investor based in London. You're interested in an Indian company listed on the Bombay Stock Exchange, or BSE. Instead of directly investing in the BSE, you approach an FII, like a global bank, that already has a presence in India. This FII issues you a P note, which is a derivative contract. This P note's value is linked to the performance of the Indian company's stock you're interested in. If the stock price goes up, your P note gains value, and if it goes down, your P note loses value. The FII, in turn, invests in the Indian company's stock on your behalf. You don't own the shares directly, but enjoy the benefits and risks associated with the stock's performance through the P note. This process allows foreign investors to participate in the Indian market with more flexibility and less regulatory burden. While P notes offer convenience, they also raise concerns about transparency. Since the actual identity of the final investor is masked, there's a possibility of misuse, like money laundering or market manipulation. To address these concerns, SEBI has implemented regulations to monitor P note investments. FIIs issuing P notes need to register with SEBI and disclose details about their P note issuances regularly. These regulations aim to strike a balance between attracting foreign investments and maintaining market integrity. SEBI constantly reviews its regulations to ensure they are effective in mitigating the risks associated with P notes. By keeping a watchful eye on P note activities, SEBI attempts to ensure that the benefits of foreign investments outweigh the potential risks. Section 4. The two sides of the coin. P notes have both advantages and disadvantages for the Indian market. On the positive side, they attract foreign capital, which is crucial for economic growth. This influx of funds can boost the stock market, strengthen the Indian rupee, and support various industries. Moreover, P notes provide foreign investors with a more accessible route to participate in the Indian growth story. This can lead to greater market depth and liquidity. However, the lack of transparency in P note investments remains a concern. The masked identities of ultimate beneficiaries make it difficult to track the source of funds, raising apprehensions about potential illicit activities. This lack of transparency can also contribute to market volatility, as large-scale P note investments or withdrawals can significantly impact stock prices. Section 5. The verdict. Should we worry? So, should investors be concerned about P notes? The answer isn't a simple yes or no. P notes are a tool, and like any tool, they can be used constructively or misused. While the risks associated with P notes are real, SEBI's regulations aim to mitigate these risks. The key is to find the right balance between attracting foreign investments and maintaining market transparency. Investors should stay informed about SEBI's regulations and monitor any news or developments related to P notes. By staying vigilant and understanding the evolving regulatory landscape, investors can make informed decisions. Section 6. A balancing act. The debate on P notes highlights the ongoing challenge for emerging markets like India. Attracting foreign capital is crucial for growth, but it's equally important to safeguard market integrity and investor confidence. P notes, with their blend of advantages and risks, represent this delicate balancing act. By implementing robust regulations and adapting to changing market dynamics, India can harness the benefits of P-notes while mitigating their potential downsides. Ultimately, a well-regulated and transparent environment will instill confidence in all market participants, paving the way for sustainable and inclusive growth.